Stop me if you've heard this before. You need to start investing. You need to put 15% in your pension. You need to buy property. No, wait, the property market is crashing. Actually invest in gold. Avoid tech stocks. There's an AI bubble about to burst. It's exhausting, isn't it? Everyone's telling you to invest, but no one is actually showing you what, how, or where to actually invest in without making your head spin. In today's video, I'm cutting through all the noise. I work in fintech, I've been investing for years, and I'm going to give you a simple, tried and tested investing strategy that actually works. No jargon, no confusion, just a clear plan that you can actually start today. Without further hesitation, let's get right into it. Hi guys, welcome back to the channel. If you're new here, I'm Chidera and I talk about personal finance, investing and building wealth in the UK. So if it sounds like your vibe, please hit the subscribe button. Now, before we dive into the rest of the video, I want to tell you something really exciting. So I'm going to be hosting an investing masterclass, okay, where I'm going to show you what to invest in as a beginner. It's completely free. If after watching this video you still need further guidance, make sure to sign up for the masterclass. Link in the description box to sign up. So now let's start with the most important question. Why is investing important? Why does it matter? At its core, right, investing is simply using your money to make more money. It's not gambling. That's one thing a lot of people tend to confuse it with. It's not gambling. It's not a get rich quick scheme. You're just putting your money in places where it can grow over time. And here's why you need to invest. The first reason is that inflation is eating away at your money. So here's the thing, prices go up every year, but your money is just sitting there doing nothing. It's not keeping up with inflation. Rather, you're losing value due to inflation. Let me explain. So for example, I have a phone here. Assuming this phone right now, I can buy this phone for, let's say, £1,000, and right now I have £1,000 in my account. But then next year I want to buy this phone and I've been told that this phone is now £1,200. That means the £1,000 I have in my account can no longer buy this device. So what that means is my money has lost value. Even though the money is still the same, it's lost value because it cannot even buy this phone anymore. And that is why you need to invest, so that you can keep up with inflation. Now, the second reason you need to invest is that investing is actually how you build wealth. One of the ways that the rich get richer is by owning assets. One of the fastest ways to build wealth is to own assets. This can be you owning a company or you having ownership through stocks and shares. Basically, ownership is the pathway to wealth building. Now, so think about it. Someone who bought a house 20 years ago, the house has probably doubled in price. Or think about someone who's been investing in the stock market for like 8 to 10 years. Their money has already grown about 7 to 10% during this period. But then someone who is earning salaries, rarely do salaries keep up with inflation. If you want to stop feeling like you're constantly behind financially, then you need to start investing. So investing may sound intimidating, but by the end of this video, you will have a simple framework that you can actually implement today. So now let's talk about the stock market. How does the stock market work? It's actually not that complicated. I think one of the things that a lot of people struggle with is all the jargons that has to do with investing, but I'm going to break it down simply for you. So essentially, what is a stock? When you buy a stock, you're buying ownership in said company. So if you buy one share of Netflix, it means you own a portion of Netflix. If you buy a share of Amazon, it means you own a little portion of Amazon. That's how that works. Now, the question is, how do you make money from stocks? There are two ways you make money. The very first is that the stock price goes up. So imagine you buy a stock, let's say for £10, and then later on the stock price increases to £15. That means you've made £5 on top of that £10 that you invested. That's the first way to make money from stocks. Now, the second way to make money is dividends. Dividends is when the company shares a portion of their profit with you. It's kind of like a way of saying thank you for investing in us. Thank you for believing that, you know, we can make money, right? And here's a bit of our profit. Let's share it. So that's what dividends is. The thing to know here is that not all companies pay dividends, but those that do usually pay it every 3 months or sometimes once a year. So now the question you're probably thinking is, should you just pick a stock and invest? Well, you could do that, but the problem with that is that even the biggest companies can fail. I mean, if you cast your mind back, there was a time when BlackBerry was the biggest thing after sliced bread. Literally, almost everyone had a BlackBerry device. And at that time, BlackBerry's stock price was doing very, very well. And the stock was worth over £100. But today, BlackBerry stocks are worth less than £3. So what that means is if you invested in BlackBerry and held on to it till now, you've probably made a huge loss in your investments. Or even think further, what about Nokia? There was a time Nokia was the biggest phone out there, but right now you can probably count the number of people around you that still have a Nokia device. Picking individual stock is not the best beginner friendly approach to take. So what what do successful investors do instead? What they do is that they don't try to pick stocks. Instead, they buy all the stocks from the big companies at once through something called an index fund. All right, so this is where it gets good. So an index fund is basically like a basket of hundreds of companies for you to invest in. So when you put money into this fund, it is spread across all the companies that are in that basket. So by doing that, your risk is diversified. So even if any of the companies there crashes, the chances that all 100 companies will crash at the same time is very unlikely. So instead of putting all your eggs in one basket, for example, Netflix, Apple, you just spread out your money across lots of different companies. So for example, let's look at a popular index fund, which is the S&P 500. The S&P 500 is an index fund that comprises of the 500 biggest companies in the US. So when you invest in the S&P 500, you're essentially investing in Apple, Microsoft, Amazon, Google, Tesla, Coca-Cola, McDonald's, and 493 other companies. So if some companies go up and some go down, you still benefit overall from the upward market trend. How well does this perform? So let me put it into perspective for you using numbers. Assuming you invested £1,000 in the S&P 500 about 30 years ago and reinvested all of your dividends, by now you have about £17,000. That's a return of roughly 10% per year on average, or roughly around 7 to 8% after you factor in inflation. So essentially you turned £1,000 into £17,000 without doing anything other than putting your money into the stock market. You might be thinking, why don't I just own the biggest tech companies instead? Why don't I just own Google, Amazon, Apple? I get it, these companies have had massive returns. However, the big players today might not necessarily be tomorrow's winners. So the point is, you don't know which companies will be at the top in 10 years. So rather than trying to play a guessing game, just own a little bit of everything. So how do you own a little bit of everything? This is what is called diversification. This is where diversification comes in. Diversification is when you reduce your risk by spreading your money across different geographical regions, different industries, and even countries. Okay, so for example, instead of just investing in the US, you can invest in UK companies through ETFs like the FTSE 100, FTSE All Share. You can invest in global companies using index funds like the FTSE Global All Cap. You can invest in emerging markets like companies in Latin America, Africa, Asia. By owning a little bit of everything spread across different regions, industries, and countries, you are reducing your risk. So once you diversify this way, if the US market struggles, then probably the UK is doing well. If the UK struggles, probably Asia is doing well. Or if you diversify by industries, if tech is struggling, then maybe biotech is doing well or pharmaceuticals is doing well. So diversification is the key to minimizing your risk. So now that you know what to invest in, let's talk about how do you start investing? How do you actually put your money into the stock market? Now, the very first thing you want to do is to pick an investment platform. In the UK, there are so many platforms that allow you to invest with as little as £1. Some popular platforms include Vanguard, Hargreaves Lansdown, Trading 212, AJ Bell, and so on and so forth. But when you're picking out a platform, what you need to look out for is that one, they are regulated, okay? Ensure that they are regulated by the Financial Conduct Authority. Two, ensure that they have low fees, because one of the biggest things that will eat into your wealth when investing is fees. Platform fees, management fees. You need to ensure you are going for the one with the lowest fees as much as possible. And thirdly, easy to use. There's no point using a platform that just complicates investing for you. So you want to ensure it's as easy as possible to use. Now, the second thing to do is to choose the right type of account. So in the UK, you have a few options. The first is the Stocks and Shares ISA. This is an individual savings account that allows you to invest tax-free. So essentially, any money or returns you make on your money is tax-free. You won't be liable to pay taxes on it. Most of the platforms that I already mentioned for investing, they allow you to open a Stocks and Shares ISA with just a few clicks. With the Stocks and Shares ISA, you can only invest £20,000 every tax year, okay? After that, it resets the following tax year. Now, the second account you can use is called a General Investment Account. Now, this account, there's no limit to how much you can contribute. However, you will be liable to pay taxes. As a beginner, you're better off starting with a Stocks and Shares ISA only if you've exceeded the 20,000 limit and you need to invest more money. Should you then consider using a General Investment Account, because you'll be liable to pay taxes on the returns in this account. There's also a Self-Invested Personal Pension, SIPP. So it's an account you can use to invest into pensions, okay? But the problem with this account is that you cannot access the money until your pension age, which I think the minimum right now that you can access the money is 55. And this age can actually be revised in a few years. years. Now, the third step is to add money into this account. So once you've opened the account, a stocks and shares ISA in this instance, then you want to pay money into that stocks and shares ISA account. Now, this is where a lot of people get it wrong. A lot of people think once you put money into the stocks and shares ISA, then you've invested. No, the stocks and shares ISA is just a bucket. It's just an account. When you pay money into an account, the money is just sitting in the account. You then have to invest it after paying it into the account. I hope I'm making sense. You can start with whatever amount is comfortable to you. I always say it's best to start little, and then as you build your confidence in investing, you can then increase the amount over time. But the most important thing is that you start. So after that, the next step is to choose your investments. I've already mentioned a couple investments in this video that you can start with that are beginner friendly. So if you are still not sure which one to start with, the FTSE Global All Cap is a good one to start because it gives you exposure to global companies and not just restricting you to a particular region. Fifth and final step is to automate it, okay? You want to remove friction as much as possible and make it run without even you thinking about it. So set up a direct debit to remit into your investing account. Some platforms even allow you to just automatically set up the direct debit to invest into the fund directly. So ensure you set up a direct debit and automate it as much as possible, so you don't even rely on your willpower and you don't even get to have this internal debate at the end of every month wondering whether you should invest or just keep the money. So £50 a month, £100 a month, £25 a month, whatever you can afford. This is called dollar cost averaging, where you buy the stock. Sometimes the price will be high, sometimes the price will be low, but eventually the price would average out. And this is a good strategy to have towards investing, where you're investing consistently over time. So now let's talk about the fear that most people have from investing, which is, what if it all goes wrong? What if I lose all my money? Let's talk about it. So first of all, the market will always go up and down. That is guaranteed. The market is going to fluctuate. Sometimes you might open your investing app and see that everywhere is red, meaning you're losing money, or sometimes it's all green and it's going up, meaning your money is growing. It's always going to fluctuate. Let's just get that clear. Now, but what history tells us is that the market will always recover. You can expect downtimes, but also know that it will come back up. And that's literally what history has shown us. I'm not making this up. This is how it's been historically. So for example, if you look at the S&P 500 over the last 100 years, it's gone up overall despite, multiple crashes. So for example, there was the Great Depression of 1929 where the S&P 500 really crashed. There was also the dot-com bubble, or in the year 2000s, where there was also a crash with the S&P 500. And then there was the financial crisis of 2008, the COVID pandemic of 2020. So overall, even though there's been multiple crashes, the S&P 500 has bounced back historically. So if you invest in the stock market, the main thing is to have a long-term approach, okay? Because the longer you stay in the stock market, the more time you have to ride out the up and downs of the stock market. So investing is a long-term thing. It's not something you do now and the next year you want to take out your money. So the biggest risk when it comes to investing is not really the stock market, it's actually you, okay? When you rush to panic sell. A lot of people that started investing, once it's going red, they pull out all their money. You don't want to be that person who panic sells. So that's why you need to have a strategy and a clear approach to what you're doing with investing. What happens is that when the market dips, these people that withdraw their money then make a loss, because you're then taking out your money when the market is going down. You're definitely going to get out less money than you actually put in. So panic selling is something you want to avoid as much as possible. Stick with it, stick with the ups and downs of the market. And that's why automation is very important, because it removes emotions from the decision. You're just investing every single month on autopilot. So how do you protect yourself? I've already mentioned this. One, diversify as much as possible across regions, across industries, across countries, okay? The second thing is to invest for the long term. Don't have a short-term horizon when it comes to investing. If you need that money in less than 5 years, then you're likely better off saving it. Third is to automate it, set and forget it. And lastly, don't panic sell, ride out the dips. Right now, let's do a quick recap of your action plan. What do you need to do now that you've gotten to the end of this video? The very first thing is to open a stocks and shares ISA account. Today, figure out a platform, just open one. Just ensure they are FSCA regulated. Pick a platform, open it today. Second thing is to choose a global ETF, one that gives you exposure to global companies and investing. Pick an amount, put any amount in it today. If it's £10, £25, whatever it is, invest, put some money today. Don't put it off, do it today. Thirdly, set up a direct debit of a certain amount, maybe £5 a month, £25, £100, £500, whatever you're comfortable with starting. Lastly, leave the money alone and let it grow. Basically, don't try to time the market, just stay consistent and invest in diversified funds. So once again, reminder that I'm hosting a free masterclass. If you've gotten to the end of this video and you still need further help, or you want to be able to talk to me directly and ask your questions directly and get responses live on a call, link in the description box below to sign up for the free investing masterclass. All right guys, so there you have it. If you've been thinking about investing and did not know where to start, I hope this video has given you a simple action plan and help you understand how investing works. So drop a comment down below. Have you started investing? If not, what's stopping you? Leave it down. I would love to hear back from you. Till next time guys, thank you so much for watching. Bye bye.